You don't need to be rich to trade options. You just need to understand 4 moves. And today, I'm going to show you exactly how to use them to make money, protect your portfolio, and get paid while you wait. Let's make options simple. Let's start with the most well-known, the call option. A call option gives you the right to buy a stock at a set price, called the strike price. You'd buy a call if you believe the stock is going to go up. Imagine locking in the price of Apple stock at $100 because you think it'll jump to $130. If you're right, that call becomes valuable. You can buy low and potentially sell high. Of course, you pay a premium up front for that right. If the stock never reaches your strike price, the call expires worthless. But here's the thing. Your maximum loss is limited to the premium you paid, while your upside is theoretically unlimited. So what this really means is a call option gives you leveraged exposure to upward movement with clearly defined risk. Now let's flip the perspective and look at the put option. A put gives you the right to sell a stock at a specific strike price. You'd buy a put if you think the stock is going to fall. Think of it as insurance for your portfolio. If a stock is trading at $100 and you buy a put with a strike price of $90 and the stock crashes to $70, you still get to sell at $90. That's powerful. What this really tells us is that put options are tools for protection or speculation on the downside. You pay a premium for the safety net, and in return, you limit your downside if things go south. Now let's talk about the cash-secured put. This is where things get interesting. Instead of buying an option, you're selling one, and in this case, you're taking on the obligation to buy a stock at a certain strike price if it drops there. But here's the payoff. The market pays you for that obligation. Let's say you want to own a stock, but only if it drops from $100 to $90. You sell a put option with a $90 strike price and receive a premium, maybe $3 per share. That's $300 in your pocket per contract. If the stock doesn't fall, you keep the premium as profit. If it does fall and you get assigned, you're buying a stock you already liked, just at a better price. But what this really means is you're getting paid to wait. You need to have the cash ready, of course, because if assigned, you must buy the shares. But that's why it's called cash secured. Finally, let's look at the covered call. This is a strategy for investors who already own the stock and are okay selling it at a specific price. You sell a call option on your shares. If the stock rises above the strike price, you might have to sell your shares at that level, but you keep the premium regardless. If the stock stays flat or dips, you still own your shares, and the premium is yours to keep. What I mean by this is you're essentially renting out your stocks for income. It's not flashy, but it's steady, and one of the most disciplined ways to earn passive income while holding on to your positions. The downside? You cap your upside, but the trade-off is you create predictable returns in sideways markets. So, to tie this all together, the call option is your tool for betting on a stock to rise. The put option is your safety net, or your way to profit if a stock falls. A cash-secured put is how you get paid to buy stocks at a discount, and a covered call is how you get paid to hold, and possibly sell, stocks you already own. The deeper truth here? Options aren't just speculation tools. They're about control. Control over price, control over timing, and control over risk. And once you understand that, you stop following the market and start shaping your own outcomes. All right, let's talk options. And not just theory, but a real-world example. We're looking at NVIDIA, currently trading at $179.53, and we're setting up a long call trade. Stick around, because by the end of this, you'll understand strike prices, premiums, break-evens, and exactly how to read that profit-loss graph like a pro. At this moment, NVIDIA is sitting at $179.53, up 3.34% on the day. That's strong momentum. Now, on the call options chain, you can see multiple strike prices listed, from $162.50 all the way up to $187.50. Each strike has its own premium and risk-reward profile. Now, I've selected the $182.50 strike price, which means I'm betting NVDA will go above that level by expiration. The premium? $3.10, or $310 total, since each contract controls 100 shares. So what does this trade actually say? It gives me the right, not the obligation, to buy NVDA at $182.50, no matter where the stock goes, but only until August 15th, just 11 days away. Here's the thing. For me to even break even on this trade, the stock needs to rise to $185.60. That's my strike price, $182.50, plus the $310 premium I paid. So if NVIDIA shoots up to, say, $190, I'm in solid profit territory. But if it stays below $182.50, the option expires worthless and my maximum loss is capped at $310. Let's break down that little profit-loss graph on the right. The orange zone? That's your risk. You can only lose what you paid in premium, $310. The green zone? That's your profit potential, and it's unlimited. If NVDA rockets past 190, 200, even 220, your gains grow with every dollar above break-even. That center line, 185.60, is your break-even point. If NVDA closes exactly there, you've made your $310 back, no profit, no loss. This is the beauty of a long call. You define your risk up front, and your upside is unlimited. But remember, timing matters, and options lose value fast, especially with only 11 days left on the clock. So don't just guess. Use this strategy when you believe a breakout is coming soon, not someday. If this helped you understand real options trading better, smash that like button. Subscribe for more breakdowns like this. What you're looking at here is a long put option trade on NVIDIA. The current stock price is $178.39, and in this example, we're choosing the $170 strike put expiring in 7 days. The cost to enter this trade is $2.95 per share, which comes out to $295 total since each options contract controls 100 shares. Now here's how it works. When you buy a put, you're essentially betting that the stock will drop. In this case, your break-even point is $167.05. That's the strike price of $170 minus the $2.95 premium. If NVDA falls below that level, you start making money. If it stays above $170, the option expires worthless and you lose the $295 you paid. Looking at the profit and loss graph on the right, your maximum loss is capped at $295. That's the most you can lose. But your maximum profit? That's technically $16,705, which would only happen if NVIDIA crashed to zero. That's highly unlikely. But the takeaway is, your upside is big and your downside is fixed. This setup is ideal if you believe NVIDIA is about to make a sharp move down within a week. Just know, if the drop doesn't come quickly, time decay will eat into the option's value fast. All right, let's walk through this screen step by step like we're placing the trade together. NVIDIA is trading around 180.28 cents per cent. Down the left, you've got a ladder of strike prices. 190, 185, 180, all the way to $145. We've highlighted the $160 strike for a cash-secured put expiring in about 28 days. Here's the thing. Picking a lower strike, farther below the current price, usually gives you more safety but less premium. Picking a higher strike pays more but puts you closer to assignment. At 160, you're roughly $20 below the current price, about 11% out of the money, with an estimated chance of profit around 83% on this platform. That's why it's a popular income with cushion choice. Look at the bid-ask, 225, 229. We're using a limit at 225. Because one contract is 100 shares, that's $225 of credit up front. The panel even shows $224.96 after fees. What this really means is your max profit on this short put is exactly the premium you collect, $225. Against the $16,000 you must reserve for a potential purchase, 160 times 100, that's about 1.4% for 28 days. Let's break it down. On an annual pace, not a promise, 1.4% times 365/28 that approximate 18% if you could rinse and repeat with similar terms, which markets don't always allow. Still, it's a clean way to get paid to wait. On the right, it's a short put. One contract, good for day, limit 225. Estimated credit, 224.96. The platform is telling you, if filled, we'll drop that cash in your account now and we'll lock up $16,000 as collateral. What I mean by this, you're formally obligated to buy 100 NVIDIA shares at 160 if you're assigned at or before expiration. If you truly want those shares at that price, this is exactly the promise you want to make. If not, pick a different strike or don't sell the put. That little chart is your whole story in one picture. The green, flat line across the top, that's your max profit of $225. You earn that if NVIDIA finishes at or above 160 at expiration. The option expires worthless, you keep the premium, and no shares change hands. The black dot is your break-even at 157.75. Strike 160 minus premium 225. If NVIDIA lands exactly there at expiration, your profit is roughly zero after premium. No win, no loss. Below 157.75, notice the orange line slopes down. Losses grow dollar for dollar as the stock drops, because you're effectively long from the net cost of 157.75. The max loss printed, 15,775, represents the nightmare. NVIDIA to $0. That's strike times 100 minus your $225 credit. It's unlikely, but the platform shows it, so you respect the downside. Here's the thing. Higher strikes equals higher premium equals higher assignment risk. See it on the screen. 195 pays about $17.40. 190 pays $13.90. 185 pays $10.80. Drop to 160 and it's only $2.25. Bigger check, bigger danger. To the trade selected, a $175 cash secured put, 28 days, limit $6.10. That's $610 credit per contract, 100 shares, while $17,500 is locked as collateral. On collateral, the period return is $610 divided $17,500 equals 3.5% for 28 days. Pace, not a promise, 45% annualized if you could repeat similar terms. Order panel confirms. Short put, good for day, estimated credit $609.96. What this really means is you're obligated to buy 100 shares at $175 if assigned. Now the P&L graph. Max profit is the premium, $610. Break-even is $175 minus $6.10, $168.90, roughly 6.3% below spot. Above $175 at expiration, you keep the full credit. Below $168.90, losses grow dollar for dollar. Max loss shows $16,890, strike value minus premium, if NVIDIA went to zero. What is this telling us? The platform is visualizing the core rule. High risk and strike price equals high premium. Choose strikes you can live with, size for assignment, and let the premium fairly pay you for that risk. Let's read this screen like a trader. NVIDIA is around $179.74, and the strike ladder runs from $200 down to $135. We're focused on the $190 strike for a covered call expiring in about 26 days. Here's the thing. The closer your strike is to the current price, the higher the premium and the higher the chance of assignment. A $190 call is slightly out of the money, so you keep some upside before capping gains while still collecting a solid credit. Now profits and premium. The bid-ask on the $190 call is $4.90/$4.95. Use a limit at $4.90. One contract credits about $489.96 immediately. If NVIDIA finishes at or below $190, the option expires worthless. You keep $490 and keep your shares. If it finishes above $190, you'll likely be assigned and sell 100 shares at $190. What this really means is your effective sale price is $194.90, strike plus premium. With a cost basis near 179.74, max profit if called is roughly 190 minus 179.74 times 100 plus $490, approximately $1,516 in 26 days. That's getting paid to set a disciplined exit. You see short call, 1 contract, limit $4.90, with estimated credit $489.96. Use limit orders to avoid slippage, and make sure you actually own 100 shares per contract. Otherwise, you'd be selling a naked call, which is a very different, much riskier trade. About that PL graph. The mini chart describes the short call leg alone. A covered call is stock plus short call, so the combined payoff is different. What I mean by this? With a $190 covered call, your maximum profit is the stock's gain from your cost basis, per approximately $179.74, up to $190, plus the $4.90 premium, about $1,516. Downside remains normal stock risk, softened only by the $4.90 cushion. The premium reduces losses, but won't protect a big drop. Your break-even equals cost basis minus premium, per approximately $179.74 minus $4.90 equals $174.84. If the stock finishes above $190 and you're assigned, you sell at $190, keep the $490 premium, and your effective exit is $194.90. What is this telling us? Pick strikes that match your goal. Go higher, like $195 or $200 for more upside, less income. Go lower, like $180 or $175 for more income, higher assignment odds. Manage actively. Many traders buy back the call when it's up 50 to 70%, roll out, or up for a credit if price pressures the strike. Avoid selling calls right before earnings or ex-dividend unless they're fine with assignment. And always size so a sale at the strike is acceptable. Bottom line. This setup, $190 strike, $4.90 premium, converts your NVIDIA shares into a paycheck now and a rational sell target later. Price the risk, use limits, and run the process consistently.